In your previous podcast, you mentioned how dips due to viral outbreaks tend to be shorter term. You get bounce backs to previous level once the issue in hand has died down. Obviously, this is more significant, but given the stimulus packages we are seeing, is there a possibility that once the threat of the virus subsides, things will be overstimulated, or do we see this causing more lasting, irreparable damage that will need more nurturing once the immediate threat subsides? Now, it's a good question, and we don't know. Now, somewhere else in the question list, there's people talk about hyperinflation as well. So that's one of the things of where perhaps if you keep overstimulating, so you make the currency weaker by cutting rates or printing more money, then things will cost more. You need more pounds that are washing around the system, and it will drive up inflation. One thing I would say on that is that if you look at the financial crisis, everybody said that would happen afterwards because we had all this stimulus back then. Maybe not to the same scale that we're going to end up having this time, but we had it last time. And inflation never, ever escalated in such the same way. It never peaked. So I'm not saying it won't, but we have a 12-year window after the last set of stimulus. We were being stimulated for the whole time as well, because interest rates never really got back. Well, they never got anywhere near back to normal. So that means, if you take that as a guide, we probably are in the lower for longer regime when it comes to interest rates. And it is possible we could get hyperinflation, but history says recently that perhaps the odds of it are maybe overstated. Now, on the point about will we bounce back, stock markets are interesting because they tend to discount what's going on. So 3 to 6 months ahead is where they tend to look. So we tend to bottom way before we get the economy bottoming. And so therefore we could see something of a bounce back at some point. Like I said before, it could take years to get back to where we were. The danger we've got is that that we could have some huge damage because of the number of people that become unemployed, and we end up in some kind of depression. It's not guaranteed, and I don't think it necessarily will happen given all the stimulus, but we just don't know. So, from an economic standpoint, it's going to take a long time. From a stock market and investment standpoint, the end will probably be sooner than the economic downturn. That doesn't mean it's going to be tomorrow, and it certainly doesn't mean the market won't fall further. Somebody actually mentions later on, if you've cashed out, when do you reinvest? Now, if I knew that, I'd be not doing this recording in my living room. I'd be doing it on a desert island somewhere. But the key things, I think, just generally for people, I talked about it in midweek markets as indicators. They don't guarantee the market's going to turn around. We can never get the bottom. But if you look at history, there are lessons, and it's when the VIX, the VIX, if you Google that, you can see it, which is the kind of, it's called the fear gauge for the market. But what it does, it's really a sort of a measure of volatility of the S&P 500. That's up about 60, and it's been going between 60 and 80. Historically, it's normally near 20 or below, and recently we've been down to like below 15. When that gets down towards a 200-day moving average, that has been a bit of a all-clear signal for markets in the past. So it doesn't mean it will be this time, but that number is 20. We are still up above 60. The bond market needs to settle down, and we need to see more stocks being above their 200-day moving average to get, they call that breadth. So we don't know when is the time to reinvest, but if you've cashed out and the market is obviously at a lower level, then you are winning anyway if you reinvested. You can also drip in. I think people always think they've got to get the bottom, and it's been proven the strategy, if you've got cash and you think the market will fall further or you're worried, is to drip in because of pound cost averaging, which I've talked about previously. So it's something to bear in mind. I don't know when the market will bottom. There are signs that this could be just a bear market rally that we've had in the last week, and the odds are that it probably is, and we're going to end up having testing new lows. I hope we don't, but if you look at previous stock market crashes, 2008, go back to the dot-com bubble. You get the biggest rallies in bear markets, so that can be a negative. That's just reality.